State Bank of India facilitates more capital movement than any other commercial entity, functioning as the primary pipeline for the world's fastest-growing major economy. The bank currently commands 22% of all deposits in India and manages 20% of the nation's total loan book. In the last 5 years, its financial performance has accelerated. Annual net profits have more than doubled since 2022, reaching a record high of over 80,000 crore rupees in fiscal year 2026. Yet the market is pricing these records at a deep discount. Despite its growth, SBI trades at a price-to-earnings ratio of just 11.4. This chart shows the gap between public and private valuations. While SBI sits at 11.4, its private sector peers like HDFC, ICICI, and Kotak Mahindra command significantly higher multiples, ranging from 14 to over 19. This creates a significant conflict for investors. It raises the question of why the most dominant player in the sector is being valued as though its growth has hit a ceiling. Brokerages like Jefferies argue the market is simply wrong. They maintain a buy rating with a target price that implies the stock could rise nearly 30% from its current levels. This bullish stance is based on a massive internal cleanup. For years, the bank struggled with a legacy of bad loans, but recent data suggests that era has ended. Gross non-performing assets declined sharply. Between 2022 and 2026, bad loans dropped from 4% to 1.49%. Furthermore, the bank scaled its provision coverage ratio to 92%, creating a massive cash shield that neutralizes the impact of remaining bad debt. Operationally, the bank is leaning on digital expansion. Its YONO platform is capturing a larger share of new accounts, while bancassurance tie-ups are increasing non-interest fee income. To analysts, these metrics indicate a completely restructured institution that is far more resilient than its current valuation suggests. However, the broader market remains hesitant to pay a premium. If the balance sheet is truly a fortress, we have to look at the short-term mechanics that are keeping prices down. The primary concern is the net interest margin, or NIM. In the fourth quarter of 2026, this margin dropped to 2.93%, signaling that the bank's profitability on loans is tightening. This timing mismatch occurs because deposits reprice and mature faster than loans, raising costs before income catches up. This squeezes margins. The bank pays higher rates to depositors today, but must wait for long-term corporate loans to mature before resetting them at higher levels. Added to this is the board's approval to raise 60,000 crore rupees in new capital, but investors are wary of capital dilution. They are waiting to see if management can actually deploy this new funding into the 13 to 15% credit growth they've promised for the coming year. For the market, the 11.4 multiple isn't a mistake. It's a discount applied to account for upcoming risks in margin stability and capital execution. That 11.4 multiple is a mathematical snapshot of a market in disagreement. It prices in both the bank's record profits and the uncertainty of its current transition. While the market focuses on near-term margin pressure, long-term investors are looking at a stock trading at just 1.4 times its estimated book value for 2027. The resolution to this disagreement arrives on August 7th. That is when the board will review and release the financial results for the first quarter of fiscal year 2027. Analysts will be looking for a single sign: whether the management has stabilized the net interest margin while maintaining its pace of loan disbursements. A positive result could lead to a rapid re-rating, as investors lose their justification for the deep discount relative to private banks. This is a direct collision between reported earnings and market skepticism. August 7th will serve as the first major test of which side has correctly read the bank's future.